Welcome to this analysis video, where we deeply look into the Duolingo's report numbers and we give a fair valuation for the company. This is StockScope. Let's get started. Duolingo is a software education company that helps its users mainly to learn languages and wants to position it as a serious referent. We will start looking at the earnings reports. As we can see, Duolingo is a solid company that grew last year on exceptional numbers. They improved every metric approximately at 30%, and they got more than $1 billion in cash. Things to focus on: the daily active users. This is the main metric to focus, and the most conflictive, as reflects the users of the app. We see the company generates more than $1 billion in revenue, so we can conclude, without further detail, we are talking about a solvent and profitable company. So what the flick would happen so the company crash from those numbers? The company accumulates more than an 83% crash since its highs and still going. All started on May last year. After an extreme rally, the stock began to go down and down and down to the levels we can see nowadays. Let's check now why this happened. All this crash started, and it still goes because of the company's future, the company's guidances. Louis von Ahn, Duolingo's CEO, has shifted the company's strategy from being extremely profitable through subscriptions programs to expansive strategy, as it is expanding the users base of the company. He has added more free features and reduced the benefits of premium learnings plans to be able to capture and retain more people into the app. So let's check the future guidance. Bookings, as well known as subscriptions, are guided to grow only on the lower teens, when last year grew up to 33%. So this is the main number where we can see the strategy shift. Also, margins are compressing more as the AI expenses increment for the free plan of the app. I have deeply checked into the company, listened to the company's earnings webcast and more on, so I can firmly say I am an absolute expert of the Duolingo model. This company has a massive bull case. The strategy the CEO is following not only is the most profitable one on the long term, to generate value to investors. Louis said on the webcast that only the 2% of the people who has access to internet on countries as the US use the app, so there's further progression to do, and it does not exist a user-based problem or limit. The bull case goes through accomplishing teaching better through AI to retain users and to grow users on the new learning features, math, chess, music and more coming. The biggest bet of the company is their 2028 objective, getting to 100 million daily active users. This is approximately 100% users growth in 3 years, so it can be a massive bomb. Louis is the person that knows the best how the company works, and I think he can manage his way up to the objective. If there's someone who can do it, it's him. If all this works on the company, it's expected to launch its valuation and grow at extremely high levels, what would be very profitable for investors. As there's a bull case, a bear case must be analyzed too. Lastly, the company is facing some big issue problems, and one of them is marketing. Duolingo's TikTok and Instagram is not getting the views once did. As a matter of fact, I think they are the worst in much time, and this is stopping the company to traffic into the software lots of users. The main bear case analysts think about and justifies the company's stock price in this moment is AI and the high competition environment the company could face, as copying and programming. The Duolingo software ain't difficult to copy, but what's difficult, it's to get their reputation, their marketing power, and their cash. This is what makes difficult that another company can appear. Another bear case is, if the company cannot convert those daily active users and can't get to the 100 million number, that is the first step. Second step will be to convert all the millions of users onto subscription programs, because more or less only 8% of the users is paying a premium plan, while apps like Spotify got 50% of the users with a premium plan, so there's room to work there. Finally, the last bear case is, if people does not want to learn any more languages as AI comes a daily real-time tool. We firmly think this last case is not real cause. People learn languages as a way of connecting with a culture and its people, for individual knowledge and for fun, and all this won't be replaced by AI. What do you think about the bear cases? Leave a thought on the comments. Forget the accounting noise. Let's look at the financial bedrock, the free cash flow model. This is the actual liquid cash the business generates. Here are the exact parameters of our stress test. First, our baseline. $7.23 in free cash flow per share over the last 12 months, fully accounting for share dilution. Next, a conservative 14% growth rate. This actively prices in the margin compression and friction from their massive new AI investments. Then, a terminal FCF multiple of 30x, the industry standard for a debt-free SaaS monopoly at maturity. Finally, our safety net. We demand a strict 12% annualized return on our capital. Look at the right side of the screen. When you run those numbers, the math dictates that the fair entry price for Duolingo today is $236.97. Where is the stock actually trading after the recent market panic? Right around $100. The market is pricing Duolingo as if the core engine has failed. But this cash flow model proves the foundation is completely intact. Buying at these levels means acquiring a highly efficient cash machine at a massive structural discount. Now let's run the exact same stress test using the EPS model. This is the pure accounting view, heavily penalized by stock-based compensation. Here are the punishing parameters. First, our normalized base EPS of $3.16, the same conservative 14% growth rate. We drop the exit multiple to a pessimistic 25x, and we demand a massive 15% annualized return on our money. Look at the results. Even under these absolute worst-case constraints, the math gives us a floor value of $75.62. With the stock trading near $100, this outlines our maximum downside risk. But remember, EPS is an accounting illusion. The free cash flow model we just saw is the actual engine. The downside is rigorously capped, but the upside is completely open.